I'm Michael Fox, and this is the Prospector podcast. And we're on location in New York City at the Current Trends in Mining Finance Conference put on by the New York chapter of the SME. And I'm sitting across from good friend Mike McGlone of Bloomberg Intelligence. We get to do this face-to-face every once in a while, and this is one of those opportunities.
It is good to meet with you and see you. I think the last time I saw you was in Florida, in Miami, wasn't it?
It was. We had a good conversation about copper staying high up, and copper still is high up for where it should probably be. But that's not what today's conversation's about. We're going to take a darker turn. I laughed on Monday night. You gave your keynote speech here at the conference, and you said that your colleagues like to call you Mike McGlone. McGlone.
Yes.
Yes, and I thought that was pretty apropos because a lot of the charts that I've been seeing coming from you lately keep drawing comparisons. They compare to some dates in 1930s. They draw some comparison dates to the 1970s. Yeah. They draw some comparisons to 2008. I'm a bit of an historian, and I look back, none of those were good times. So let's talk about why those charts are showing up with those dates and maybe how people should be looking at it.
Well, I like to, that was my metals team based in London, started calling me McGlone last year. And I was just pointing out the trends that are very favorable for gold and very unfavorable for things like crude oil and potentially U.S. stock market. And one of the key things that my McGlone was coming from was bond yields in China collapsing. It's a pretty significant bull market in prices, but bear market in yields. It means deflation. But what you mentioned is that's why I like to tilt over to McFacts. I don't like to have to bring out those dates, but that's just what comes up when I analyze the spreads and ratios. So first of all, you look at U.S. stock market capitalization to GDP. We got to 2.2 for a little bit last year. Now we're down a little bit below 2. That was the highest in 100 years. The most significant recent examples in history are 1929 in the U.S. and 1989 in Japan. Obviously, I'm too young for 1929, but 1989 is when I started in the business, 1988, and I started trading treasuries at night with Japanese clients. So I know that what happened very well. And then you look at things like copper. Let's look at gold silver ratio. As we speak today, this is May 20th, it's 100 ounces of silver per 1 ounce of gold. We've the highest year, if we stay there by the end of the year, it'll be the highest year-end close ever. And, you know, my data goes back to the 70s, but we know well before that it was lower. The most highest close ever was on a year-end basis, 91.5 ounces of silver per 1 ounce of gold in 1991. That was a pretty significant recession. Unemployment peaked in 1992 at 7.8%. Right now it's 4.2. So it's only going up. So that's the key thing I like to point out is just look at all these ratios, Michael. It's just a sign that the thing that I think is happening, the lessons of history are you always get deflation from significant inflation on the back of very significant pumps in money supply and fiscal monetary stimulus. And we know the biggest money pump in history was from 2020 to 2022. Massive stimulus globally, most notably U.S., and we pumped risk assets up. So the U.S. stock market, S&P 500 total return since the end of 2019 is up 100%. Gold is up about 120%. And my point is the risks now that we have a little bit normal back and fill in that U.S. stock market with potential reason, which was happening with tariffs, and we get some normal deflation from the inflation, which is what always happens in history. It's a matter of time. Now, people like me thought it was going to start in 2023 with the recession. We didn't get that. And now we have risk assets so elevated, and we have a major shift in policy in the U.S., which might be the catalyst for just taking back some of those most expensive risk assets in history. One thing also, it's the U.S. stock market versus the rest of the world. It's highest in 100 years. At least it was a few months ago. And the question is, can that stay elevated? And I'll end with this. What I see with crude oil collapsing, most notably because of lack of demand, excess supply, particularly coming out of China, facing tariffs, and gold taking off on a global basis, that ratio, which is close to, I think it ended April around 56 barrels of WTI per 1 ounce of gold, was near that 2020 high. But when gold goes up and crude oil goes down, that's a pretty serious sign of global deflationary forces kicking in. The key question you have to ask yourself is, what stops this? So key thing is I was going to end with, but I'll point out is the Fed can't really ease because inflation's too high. Risk assets went up too much. The U.S. is cutting off fiscal stimulus, and we have tariffs. These are all things before that kept risk assets elevated. Now we're kind of hovering here. Where do we go next? So I hope by this time next year, it'd be wonderful if the stock market's higher, because I think the risks are it's not.
Yeah, I mean, personally, I've been noting the trend lines of the S&P, and contrary to what happened yesterday, we're recording this on Tuesday the 20th, but yesterday was a prime example of buy the dip crowd came flooding back into that marketplace. They had the largest volume that they've had in an awful long time, and it drove the prices of everything on the S&P back up again. In spite of exactly what you're saying, everywhere you look, there's warning bells and sirens and flashing lights that say the party's over. But Joe Q Market isn't kind of cottoning on to that. They're not learning the lessons of history, are they?
Well, that's the sad thing about human nature sometimes, and that's one of the wonderful thing about what I do as a strategist. I have to, for all our listeners, completely respect that they're doers. I just a sayer, but it's not appropriate for me to be involved in any trades. My firm doesn't let me because it'll distort my views. In my senses, one thing I have advantage sometimes being at Bloomberg is I get to deal with some of the thousands and thousands of top investors on the planet. I don't really know what they're doing, but I get the questions. And right now I'm getting a lot of questions about, Mike, why didn't I buy gold 4 years ago? Rock's been beating stocks for a long time. And I'm getting a lot of sense there's a major shift away from U.S. stock market and risk assets. We have a very elevated dollar. We have the highest stock market prices in 100 years versus GDP in the rest of the world. And it's simply imprudent not to lighten up on that when it makes you overweight long. And I sense that's what happening. From American investors who've made a lot of money, who have very elevated dollars in risk assets, lightening up some of those and investing overseas and other alternative assets. Gold is a major alternative if you don't want to go overseas. And also from overseas investors are seeing that, oh, thank you for the wealth creation. Maybe I'll get back and store some of it. So this to me is also what's notable is if you look at the U.S. stock market and the dollar and gold and things like Bitcoin have been the exact same trade for almost 10 years, upward to the right. Now they're diverging. The stock market's tilting lower. It's bounced, which is great. The dollar's staying down, which means there's sellers. Cryptocurrencies are rolling over. You look at broad index and gold keeps going up. The key thing for now is we have to decide, is that just a short-term blip or is it going to continue? And the number one thing on every scale of the world, everything that matters now is the severe deflation we're seeing in the rest of the world, most notably from China, bond yields, crude oil collapsing, is the final pillar for normal deflation is U.S. stock market. And that's why I'm so fearful that this time next year, we're going to be talking about a lower stock market and normal deflation from the inflation. But we're at that point now. The Fed can't really ease. That's what helped boost risk assets. Fiscal's we can't really add more fiscal, and we might, but it's getting really bad. The bond market's telling you there's a problem. And what's the key thing to remember about tariffs? In the U.S., if you're a CEO and you close a plant in Podunk or wherever, well, I'm from Chicago, suburbs, it's very politically incorrect to put people out of work, but there's only one reason you would have done that for the last 50 years, and certainly the last 20 years, is to offshore for profits. We're capitalists. We all have to have profits. You're running a company. If you're not making profits, you're out, even as a CEO. So by cutting, and there was low tariffs, but now cutting that profit motive to be offshore and have to put everything back onshore shuts off those profits. So that's a key thing I hear from my colleague, Gina Martin Adams. He's our chief equity strategist, who says that we're seeing pretty significant decline in earnings. Margins are cracking. And there's very serious bear market inklings from the stock market. But the key thing is it can't be easy. So I'd be wonderful if the U.S. stock market can just stay unchanged for a year. But, we're up 100% since 2019 on the biggest fiscal monetary stimulus in the world. Just think of it this way. If we just take back 20% of that, which means we're still up 80%, but it's not the way people look at it. It'll be the normal deflation. That'll shut down everything. The key thing is when you get to 2 times GDP, like I said, there's only 2 times in history, the stock market becomes the economy. So to me, that's what gold is sniffing out. Gold-silver ratio is sniffing out. Gold-copper. And I look at cryptocurrencies at the leader of the potential market that's going to have normal reversion like we did in 1999, the peak in 2000.
Yeah, see, that's the thing that frightens me about the charts is you keep talking about the stock market has to revert, and when the stock market becomes the economy,
It is now. Yeah.
as it is now, that likens back to 1929, that
Yep.
likens back to 2008, that likens back to 1989 in Japan.
Yeah.
Last time I checked my history books, none of those events ended particularly well. So the question I have, let's go back to the historical of 1929 and the bringing on of the Great Depression, because I see from an historical standpoint that there are a lot of similarities. You had Smoot-Hawley tariffs. They are different than the Trump tariffs, and I'll explain that statement in a second. But you also had a stock market that collapsed, and it was the economy.
Yeah.
Are we heading back to that kind of a depression, or are we just heading to like a nasty mid, 1980 style depression when we came off the energy crisis?
But it's always going to be different. The key thing is we only can look back from the past. We learn from the past. So we know what are the wrong things to do. The significance of when the Smoot-Hawley tariffs kicked in 1930s was the U.S. was a net exporter. Then now we're the largest net importer on the planet. We're shutting that off. It's U.S. corporate profits are the big deal. The thing that I'm most concerned about is we are so elevated that we have reached the apex of this U.S. wealth creation machine that really started on October 19th, 1987, when the Fed eased, Alan Greenspan eased. He was a Green Fed chairman and started that Fed put. But we all now, what's the lesson we have now is the lessons of way too much liquidity and inflation. Inflation is still rampant. It's running core measures in this country, according to our economists, are the Fed's outlook for the end of the year is 3.5 to 4%. Their target's 2 for core measures. That's not a good thing. Now we're seeing a little bit of deflation, things like services, but that's a sign we've reached the apex of wealth creation. Fed can't ease anymore to help the market because they've eased so much and created so much wealth. It's created massive inflation. Last year, the stock market increased $12 trillion in this country. That was 40% of GDP, the most in history. You can't have deflation in an environment where you're just throwing that much wealth at people. They're buying condos and stuff with that. So this year we had a little correction. And questions, where do we go from here? So we know also part of it, we've reached the limit of the most extreme fiscal stimulus or fiscal deficit spending ever outside of a war and depression, 6 to 7% of GDP. And we're trying to shut that off. What our government is doing with DOGE is very impressive to me. At least they're trying, cutting back on government spending. But this shift, as Mr. Letnick says, from public spending to private consumer investing is not going to come without discombobulation. So far, it's been wonderful. We've had one little blip, but what's the difference from the last time we had a similar blip and correction in the stock market was Q1 2020. Stock market dropped really fast. The Fed just turned on the massive money printing machine. The fiscal stimulus has turned on. What's happened this time? The market has bounced, and we don't have any of that. There's nothing to look forward to except the potential for recession. So this is where I've been pointing out is these trends were in place well before Mr. Trump was elected. It's the things I've been pointing out in the commodities I'm really worried about. When crude oil went to 130, that was a sign it would go back to 40. I still think WTI crude oil is going to go to 40. Supply is excessive, demand's declining. And by the way, the average cost of production in the U.S., you asked me a question about this yesterday, is between $50 and $55 a barrel. Typically, you have to get below that to shut it off. So there's the world's most significant commodity. Now we're replacing it. And then you look at things like silver. Why is the gold-silver ratio so high when silver's so needed for this electrified economy? You know, we're shifting, yet it's still almost the highest ratio ever. That's another sign that we're having a problem. So the key thing I like to point out is these things have been happening, and you can see these organically in commodities for a while. Plunging yields in China. Bond yields in the top 3 countries in the world that export to the U.S. They have about the same GDP as combined as U.S. is China, Japan, and Germany. Their average exports are about 25% of their GDPs. The most is Germany, 50%. What are they going to do? They can't export. They're getting shut off by the U.S. China's shutting them off with the BYDs. I mean, this is a severe. But the key thing about those countries, their average bond yields about 2%, 10-year government bond yields, and the U.S. 250 basis points above that. That, to me, is the key thing that's going to happen. I think the next trade is U.S. stock market just gives back some gains. Nothing significant, but it's not going to feel that way. mean reversion can be profound. And that'll be the deflationary force that'll bring bond yields down. I think that's what gold's predicting. So here's the opposite. Here's the risk to that. Gold, I think the next key levels getting to $4,000. I mean, 3,500 is pretty overbought. Getting to $4,000 an ounce. The key way to do that is if Bloomberg Intelligence is right that we have the recession in this country, and fair value for the S&P 500 is around 4,000 in a normal recession. To me, that's where they meet. Ounces of gold per S&P 500 have historically been 1-to-1, and just a couple of years ago it took 2.3 ounces. I think that reverts, but that's the key thing now to think forward for like metals. S&P gold is now and become much more of an S&P 500 put. The key risk for gold, I think, is if stock market goes up and people start getting rid of their gold and say, hey, why touch this rock when I can be back in stocks? But the problem with the stock market going up, Fed can't ease. Stock market goes down, then I think gold goes back towards that 4,000 level.
Yeah, that stock market going up sounds remarkably like a bubble about to burst.
That's the thing, but it's got to be as hard as possible. Like you see, that's one thing. I love your head of hair. We can't see our view. I got no hair left. And when the market first went down, my first thought is, okay, this has got to be difficult. That was too easy for people like me who was looking for it. Now it's becoming the difficult part. What's the next decision? What are you supposed to do? The dip buyers will not get out until it just can't happen psychologically. Dip buyers will never stop buying until the market stops them out. Lessons we learned in trading pits. And that's the problem. We all know it. But I think the prudent investors on a global basis are understanding, well, U.S. risk assets are too expensive for me now. It's prudent to sell and rallies.
Yeah. Let's go to something you said about the government trying to cut spending. The current budget proposal that's sitting in front of Congress right now ignores most of the Doge cuts. It's got a spending level higher than the last year of Biden's administration. And contrary to, again, people's view of Trump being more of a dove than a hawk, military spending is reaching record levels. How does that square with the markets? Like the government, the Fed might be cutting funding, but the government's still spending like drunk sailors.
It's a bit of a lose-lose, the way I look at it, because the fiscal deficit spending has become 20 to 30% of GDP. We're completely dependent on it. I mean, China's a lot more. Japan's been more too, but we're trying to cut back on that. But the tax, the whole bill and everything is, I don't see what the win-win is. Now that's being priced in the bond market. Bond yields in the U.S. are extraordinarily high versus the rest of the world. And the Fed can't ease, partly because we have this inflation, partly because of deficit spending. So I see it as a lose-lose. I don't know how it's going to end. The bottom line, I think the way it's going to end is we get the normal deflation, the stock market goes down, and it tilts everything lower. How long we can stay elevated it's a wonderful thing. The key thing I look about with what's happening with this big, beautiful bill that Mr. Trump calls it is this is going to take a while to work through the system. But tariffs and the Doge cuts are already happening, already kicking in. And I sense that the bottom line is it's unique how the stock market now guides everything. So for instance, remember we were going to do those tariffs right away, instant, and then the stock market collapses 15% or so in the air. And then and I think it was April 9th, and Mr. Trump turns around and says, oh, we'll go 90 days. Everything goes right back up. So now that we're going back up, we can push back on the high tariffs. It's going to take the stock market to go down for him to pull back. But the bottom line for this government is the bond market is telling you there's a problem. And it's very difficult for the stock market to stay this elevated if the bond market keeps telling you that, oh, by the way, we're going to keep going up because of inflation, because you're deficit spending. It's a bit of a lose-lose for equities. And that's what I think gold is figuring out and is the alternative. So I don't see what the win is from here. If we had some kind of, we're getting significant austerity from Doge. The tariffs are revenue, but the tax bill, it's just not a big fan of adding to deficits. And if they can figure that out, I wish them luck. I don't know how it's going to work. But right now we're seeing pretty good pushback from Republicans who are a bit more conservative. They know we can't spend money we don't have and keep spending excessively.
Well, you talk about it being a lose-lose, and I can't say that I don't disagree with you. But again, you've stated very clearly that the Fed can't raise interest rates, so they're boxed in. The bond markets aren't liking it. They're well, not collapsing, but they're reducing and increasing.
Versus the rest of the world, they're very high.
Yeah,
and CDS spreads are very high in the U.S.
Yes, but they're still right. They're still rising interest rates, and you've got a larger and larger budget deficit coming out of government.
Yeah.
At some point in time, the interest calculations on that are going to get us so out of whack that the government's going to be in fiscal trouble.
So here's a scenario for you. And I think the way it's going to work out. One of the primary goals for the government is to get reelected. Midterms are coming up. One of the primary ways to get the constituents to reelect them, let's remember that the top 10% of this country own 80% of the equity market. They don't typically vote for Trump, and they're not bulk enough. But the bottom 50%, they vote for Trump. They're the 55% of the world that are of this country that are wage earners, that depend on tips and overtime and Social Security. What's the primary goal of the Trump administration? And what really helps them is lower yields, lower rates. If they can buy, rent, or sell their homes with low mortgage rates, that really helps your average person that votes for Trump and in that bucket. And if they get no tax on tips, no tax on overtime and Social Security, it's a win-win. But the only way to really get yields, mortgage rates, Fed to ease, the number one way, Mike, is the stock market to go down. Now, if they can manage that, to me, that's what gets Trump elected in the midterms. The key thing I think and that's the focus of the government is, the key thing I want to point out here is what's happening in this country. The way I describe it, either Mr. Trump's going to go down in history as a failed president, or he's going to end up on Mount Rushmore. Because the way I look at it is, if he succeeds, and as he says, rebalance the global trade, which some of us agree with, the book by Robert Lighthizer just pointed out some of the imbalances. If he succeeds, he'll be looked back at from centuries from now and say, oh, this shifted the world order, pushed back on exporting predators like China and Germany, and reconfigurated the U.S. economy. If he fails, he's the number one thing to never forget about this country and our form of government, U.S. Canada, is the self-correcting mechanism. He'll be voted out in midterms. He'll be gone in 3.5 years, and we'll never go there again. If he does succeed, this shapes the world for 100 years. So I view it as just a wonderful experiment. I hate the discombobulation. I don't want people to get hurt. But the key thing, I'm from the heartland. I'm from Chicago. And I like to say I'm from part of the world. I was there before it was the Rust Belt. We've seen this happen. And you can blame it on what you want. But just offshoring, I mean, the millions of factories and millions of people I know who had to shift their lives, at least they're attempting to do something to bring manufacturing and things like that back to the U.S. I don't know how it's going to work, but the bottom line is it's that discombobulation for me as a strategist. It means it's very difficult to be able to get through this. And the key here, I'll end with this. Mr. Trump or whoever got elected is this person who got elected, it turned out to be not Kamala Harris. Mr. Trump is starting a new government program at one of the worst times in history for risk assets to only go one way. They're so expensive, the most expensive in 100 years. And whatever you do, if they can stay high, they're great. But what's normal is push back some of that overvalued, which is the trend already.
Yeah. I got two more things I want to go through with you before we wrap up today's conversation. Number one, we talked a little bit about the Smoot-Hawley tariffs in the 1930s. And this is how I view it as being different this time. Back in the 1930s, it seemed to be multidimensional. Everybody was tariffing everybody over everything. Right now, it remains a two-dimensional tariff battle. It's the United States tariffing individual countries, including penguins, which is the running joke, but it's two-way, and them retaliating against the United States back. It's not between the other countries of the world. Those tariff battles aren't happening yet. Do you see those entering into this at some point, or will this remain just a two-dimensional?
The deflationary forces out of China are wonderful for some places. I have good friends in Mexico City, so you see a lot of BYDs there. They're quiet, they're wonderful, they're great vehicles. But the deflationary forces out of China are crushing the rest of the world now. Europe has to put barriers, particularly for BYDs, because it's going to crush the German automakers. You can't do anything about that. It's the example that Mr. Besant uses of the broomsticks in Fantasia. Mickey Mouse puts the spell on, and he's a sorcerer's apprentice, but he can't stop it. There's no self-correcting mechanism in that country. There's one person China is now one person, Mr. Z. And the deflationary forces from him, and his number one goal is to stay in power. Yet the whole economy is doing what Japan did. I mean, and in the worst case, the decisive enabler of a war in Ukraine, according to NATO. So to me, that's the key thing that's happening, that the tariffs are really going to trigger and make worse. But the key lesson from the book, Robert Lighthizer, with Canada in defense of, when you have the largest border on the planet and your neighbor is the economy of 10 times the size of your country, it's impossible not to run a trade surplus with that country. There's just no, it's just the way life works. The U.S., there's no way the U.S. is going to be able to export as much to Canada as Canada can export to the U.S. when you have such a massive difference in size and GDP. It's just the way life works. Now we can work that out. So tariffs are one way to do it. I'm not such a fan of them, but that's just the way it's working. It's just the rest of the world, particularly the predatory exporters. This is a key thing I learned when I was in the trading pits in the 90s. I got my MBA in 93, and I used to go to night school at DePaul University, and during the days I worked at Chicago Board of Trade. It was a tremendous intellectual experience, kind of difficult, but what I learned in grad school is, yes, free trade is great, everything's good. You can just show global GDP increasing when you have freer trade. And I learned in the trading pits from a lot of my customers. I was on the phones, and I dealt with customers all over the world, a lot of them European, was, yeah, everybody in the world wants free trade as long as they can run trade surpluses with the U.S. That's what's being corrected. Like it or not, to me, the fact is that's going to be almost impossible to correct without some way to markets reflecting it and shifting away from corporate profits, which is what free trade was about in this country. Hey, if I can offshore and shifting back to investing in the U.S., it's great for the heartland where I'm from, but it's not good for corporate profits, which means, and it's a potential recession. So to me, that's the macro. But in terms of the only thing that really shuts it off is the stock market going down. The only thing that gets the Fed to ease right now, the main thing is the stock market going down. I don't see what gets us out of this. Like I say, if we can get through this period a year from now, stock market's above where we are now, that would be wonderful. 20% would be okay, decline. But gold, to me, is figuring it out.
Yeah. Let's go the next step then, because we talked about the tariffs, and so you see that as something that is ultimately is going to escalate. The 90-day reprieve ends on July the 9th.
Yeah.
So we are, we're marching towards, the last time he gave everybody 90 days expired and the tariffs came back. So we're on July 9th. There's no trade deals and the tariffs come back. Is that the catalyst to cause your market drop? And if so, is it a 2008 collapse kind of drop because it's happening in July when market volumes are low?
It's the problem now when you're 2 times GDP, it's all that matters is the stock market. So by the time we get to July, if the stock market's lower, they'll be pulled back on the tariffs. If the stock market's higher, they'll be pushing harder on tariffs. To me, it's almost a 1-to-1 correlation. The question's how much. It's just the way I think things work now, because people scream and cry, oh my gosh, you're taking away our wealth. It's what happens with humans. We're so addicted to this money wealth creation machine that a lot of the smart people I know said, well, I got out 2 years ago. I'm not in it anymore, because they see how stupid it is and how expensive. This is how it happens in human nature. I don't know how it's going to work out, Michael. That's why I hope and pray that we're fine a year from now. But as a strategist, I think this is the risk. It's too risky to be involved in these risk assets, particularly cryptocurrencies, because there's 15 million of them. A lot of them are worth billions, but they don't track anything. That stuff needs to be purged. And the only way you can support these highly valued, these significant, silly market valuations and things like Dogecoin, that's worth $33 billion, that tracks nothing, is when the stock market's 2 times GDP. That's how silly we are. We need to purge that. The question's when and how. And that's why I think the tariffs are going to be part of it. Tariffs, austerity, tax bill. Remember the lessons of TARP 2008, when the first time it went through, the Congress passed and the stock market collapsed the next day. It passed really fast. Now, back then, we were only like 1 times GDP. Now we're 2 times. There's things that's my duty as a strategist to point out the risk reward here. Even gold's getting expensive. You know, it's one of the most relatively best values on the planet. If you just compare versus time versus gold versus stock market versus the rest of the world, it's U.S. Treasury bills. bills and bonds. The U.S. 10-year note at 450, basically 300 basis points above China, basically 200 basis points above the top three major economies on the planet, China, Japan, Germany. And yeah, the yields are going higher, but I think we're all turning Japanese and yields will go lower, even though deficits will grow. And that's why gold and T-bonds stick, and gold and T-bonds remain my markets, I think, are going to be the best performers. And so far, so good. It'd be wonderful if the stock market goes higher, because even I'll be wrong, but the rest of the world's fine. Meaning, I'm not losing my job at Bloomberg if the stock market stays strong.
The way I look at it, sometimes it sucks to be right all the time.
Well, that's the thing. That's the most important thing as a strategist is you learn as a trader. Stop yourself out when you're wrong, admit it. Key thing I've been wrong for 2 years now is that I thought T-bond yields would be dropping a lot by now. Particularly, I expected crude oil to drop. Was way early on that one, and it is. That's deflation. Still think it's going to 40. T-bond yields haven't really dropped. Now, 10-year note yields are just starting to roll over. If you look at 200-day moving average, 5-year note yields are just starting to roll over. You look at, and certainly 2-year notes are it's starting to roll over. Even if the 200-day moving average on S&P 500 is starting to roll a little bit. So that's the key one I've been wrong, but I like to repeat. I'll end with this. The lessons I learned from Roger Babson of Babson College, a major strategist in the 1929. His quote, 1929, was, I will tell you what I told you last year and the year before. The stock market's going to go down. It's a major risk. Not with the exact words, but something like that. I used that same thing starting about 2 years ago in gold. I will tell you what I told you last year and the year before. Gold's going to go up. I was wrong. It beat on 2,000 forever and finally broke through and poof, it got above 3,000. It's just sometimes you can't predict the timing, but you can point out where things are going. That's why I like how you started out. Some of the dates, all my ratios, you have to go back to 1929, 1989, 1999, 2008. And there's a good time to just back away and not lose money and not be greedy.
Yes, greed itself is one of the deadly sins. And if we look on the history as we have today, there's a good chance that it's going to bite a lot of people in the ass. So, Mr. McFax, how do people follow your work going forward?
On your program, I enjoy our meetings and Prospect News. I enjoy on your program, Bloomberg Terminal. I'm on X at Mike McGlone 11, on LinkedIn, Mike McGlone, Senior Strategist, and on Blue Sky. And I encourage people, if you want to just reach out to me, I'm happy to put them on my distribution list.
Good to see you in person. I hope we get to see each other again before the year's over, but we'll certainly be talking in the months to come.
It's my pleasure, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.